I backtested a simple trading strategy for buying dips with very impressive results. We've all heard about buying the dip. It's one of the most repeated pieces of trading advice, but it's easier said than done. It's usually paired with a chart like this, where the dips and the entries look very obvious. And they are, in hindsight. My experience with buying the dip is more like this. Why is it so hard to buy the dip when all the charts out there make it look so simple? And how do you work out where the bottom of the dip is? Is it defined by the Fibonacci retracement levels? Or support and resistance lines? Or maybe a dip has to come down to the moving average line. You can ask a dozen people and you'll get a dozen different answers. But if you strip all that away, it boils down to a simple hypothesis. When the price drops, it is often followed by a recovery. And when you simplify it like that, it becomes easy to test. I will test this theory on the S&P 500 since there is a lot of historical data available for it. This is how the test will be set up. First, I need to work out the day's range, which is the distance between the high and the low point. To calculate this range, I subtract the day's low from the day's high. I then do the same thing for the close price to work out the distance between the close and the low. To calculate this distance, I subtract the low from the close. I can express this value as a percentage by dividing this distance by the day's range that I calculated earlier, and then multiplying the whole thing by 100. This gives me the distance between the low and the close as a percentage of the day's range. The smaller this percentage, the smaller the gap between the close and the low. I set a threshold, say 20% as a starting test parameter. If my calculated percentage is below this threshold, then I will buy the S&P. If it's above, then I don't enter a trade. The trade will be entered at the end of this day and then sold at the end of the next day. So I hold for 1 day only. So let's have a look at how this is tested. These are the parameters for my simulation. First, I need to calculate the day's range, which is the difference between the high and the low of that day. I then define a threshold for how near the day's close should be to the day's low. My long entries are taken when the price closes in the bottom n% of that day's range, which is defined by that threshold. I then measure how often this is followed by an upward move. And then I simply run the simulation over and over with various thresholds and graph them. So first of all, I import a bunch of modules. I'm going to test this on the S&P 500, and I will start off by defining a threshold of 20%. So the day's close must be within the bottom 20% of the day's range. I'll define my start and end dates as the 1st of January 2000 to the 1st of January 2020, giving me 20 years of S&P data to test on. I then download the data from Yahoo Finance. I don't need the adjusted close or the volume, so I drop them off, and this gives me this cleaned up price data. We can then plot it out to see what the S&P 500 did between 2000 and 2020. Next, I calculate the daily return by dividing the close price by yesterday's close price. I then work out the day's range by subtracting the low from the high. I calculate the distance between the close and the low, and using all of that information, I can calculate that distance as a percentage of the range. This gives me all of these inputs that I can use inside of my analysis. Long entries are only taken when that percentage is less than the threshold that I defined as 20%. I can then calculate the return of the system based on these long signals. And this is the output. We can quickly validate these calculations. For example, if we look at the percent column and pick this one here, it's 98.67%. That means that the close of the day must have been very close to the high of the day. Well, we can check that here. The high is 3240, the close is 3239.9. So that's right. The long entries only happen when this percentage value is less than 20%. That only happens here, and that gives us a value of true. When that happens, we open a trade at that day's close price, and we sell it at the next day's close, which is where we get our system return. Now we can start getting some simple metrics from this. The benchmark in this case is a buy and hold strategy, and the win rate of that strategy is 53.57%. Win rate being the number of up days compared to the number of down days. Well, the trading system won 622 times and lost 437 times, giving us a win rate of 58.73, a decent amount better than the buy and hold strategy. This was all based on me picking 20% as an arbitrary value for my threshold. So what I did next was combine all of the code above and pack it into this neat function. This function can simulate a whole range of different thresholds for me. And that's what I do in the next line. I'm going to simulate thresholds from 5% up to 100%. And this is the result here. The x-axis on the chart is the percentage threshold. The y-axis is the win rate. This orange line here is the win rate of the benchmark, which is the buy and hold. So it gives us a solid line in the sand to compare everything else to. If the system followed a threshold of 100%, then that means that the close has to be within 100% of the day's range, which it always will be. And at that point, it just becomes the same as the buy and hold strategy, which is why the blue line hits the orange line here. But you can very clearly see that as the threshold decreases, the win rate of the system increases. So there's a very obvious pattern here. The nearer the day's closes to the bottom of the day's range, the more likely it is that the next day is going to be a positive move. And we can get some statistics here. The maximum system win rate is almost 60% at a value of 7% for the threshold. The benchmark win rate that whole time is 53.57. So there is a significant difference when using this strategy. At this point, I haven't backtested the strategy. All I'm doing here is trying to prove or disprove the hypothesis. The hypothesis was, if the price closes at the bottom of the day's range, then it's more likely that the next day is going to be positive. This chart here proves the hypothesis. That means that we can take this to the next stage and actually backtest the system properly. This here is the next stage and it's the backtest. Now we have some rules that we can define for the strategy. I check if today's close is in the bottom end percent of the day's range. If that condition is met, then I enter on the close and exit the next day's close unless the signal is repeated, in which case I will hold it for another day. A lot of the code here is the same as in the study, so I'm just going to point out the differences. The first one is that I now define a starting balance of 10,000. This will give me some kind of context that I can compare the final numbers with. I can then skip ahead and look at the results of the strategy versus buy and hold, which is shown in this chart here. The light blue line is the buy and hold strategy, and the green line is the system. And you can very clearly see that the system outperforms the benchmark significantly. So let's extract some metrics and compare it in a bit more detail. Here I've got the buy and hold benchmark total returns. So over the 20 years, it returned 122%, which was 4% annually. Compare that with the system, which produced 275.8%, which turned into 6.84% annually. A significant difference. So the upside is much better. But what about the downside? The buy and hold had a drawdown of minus 56.78%, while the strategy drawdown was also quite significant, but it wasn't quite as bad at minus 32%. So not only did the strategy produce higher returns, it also protected the capital better. In addition to that, it was only in the market for 19% of the time. Because the strategy is quite selective in its entries, that means that the remaining 81% of the time, that money was available to use on other trading strategies. The overall win rate for this was 58.36%. The first impression from these results is very positive, but could it be that it's just very suited to the way the S&P behaves? Well, to check that, I've made a list of other symbols that I wanted to backtest on. I've still got the S&P here, but I also have the Dow Jones, the Nasdaq, the Russell, and the Nikkei. I then pack everything up into this backtest function where I pass each one of those symbols one by one. And I can output that inside this bar chart, where we can see that for every one of those indices that I tested, the system, which is shown in the yellow bar, outperformed the benchmark buy and hold. The difference between the two varied depending on the index, but in every single one, the system outperformed the benchmark. This additional test gives a little bit more confidence to this strategy. While this strategy seems to perform quite well on its own, it could be improved even further. For example, it could be combined with other indicators for additional confirmation. It could be paired with a moving average, where it would only go long if the price is above the moving average. Or it could be combined with support and resistance lines, so the trade is only entered when you bounce off a support line. Based on this backtest, it definitely looks like there is potential to this strategy. However, there are some important caveats to consider. Firstly, I haven't taken into account any trading fees or slippage, which is going to eat into any returns. And secondly, just because there was profit in the past doesn't mean that it's going to continue into the future. Regardless, it does seem like it could be a profitable trading strategy, and it would be worth forward testing it on a demo account to see how it holds up. But as always, this isn't trading advice, these are just the results of my own backtests. I hope you found them useful, and I'll see you in the next video.